Yes, we had a great 24, and we're actually quite pleased with the breadth of the performance. Interest income is always difficult to predict because the impact of rates is manifold. We had originally projected 4 rate cuts into 25. We're now thinking 2 at the tail end of the year. However, you have to remember that the impact of the 4 cuts in the fourth quarter, we will see the full year impact of that in 2025. And our sensitivity to rates is about $4 million per basis point. So the 100 basis points of cuts already means $400 or $500 million of interest income reduction this year. So we're starting with that. Then you got to figure how do you grow your book, grow the loan volumes to cover up the $400-500 million. Original projection was that net interest income should be flattish this year, so the loan volume growth would make up for that $400-500 million. Now, because of the fewer cuts, there might be an upside of $50-100 million on top of that. It's not very consequential, but yes, it is positive. It is a tailwind.
Okay. It was also hinted a while ago that there's going to be quite a bit of market volatility and uncertainty that we're dealing with. We've seen market activity, at least on DBS's books, also increase, for better or worse. How is DBS positioning itself for what might be seen as a more uncertain year for a number of reasons, from trade tensions to tariffs and other global uncertainties, sir?
You just have to be very nimble. Certainly with our clients, both on our corporate and our individual side, we are helping them think through a hedging portfolio and make sure that they have enough dexterity in their own investments, because I agree with you, it is going to be a choppy year. For ourselves, we are actually quite conscious of the fact that the Trump administration could use economic tools as a weapon, and therefore tariffs and tax policies, etc., can change, and that means there are 2 consequences for us. One, we are tightening up our management of things like sanctions regimes and export control orders in our trade operations to make sure we don't fall afoul of any policy directive that comes from there. The second thing we're doing is we're continuing to put more automation into our stress testing tools, so that we're going to have to keep pressing a button and keep stress testing new policies and which of our clients could get impacted. So I think it will be a year where nimbleness pays and agility pays.
Right. Have your clients sounded out concerns, perhaps, because of the growing uncertainty? And is, apart from being nimble and perhaps being more diversified, what else are you telling your clients as they try to grapple with the uncertainty that seems to change almost every week?
It's very difficult. Interestingly, through the tail end of the year and beginning of the year, animal spirits are high. So the truth is the markets are holding up quite nicely. And so a lot of people are continuing to want to put money to work, not only in traditional but also alternative asset classes. We do advise them, what you just said, that given the environment, a diversified portfolio is probably a good thing to do. A little bit defensive might be a good thing.